Imagine running a business where your top line revenue just, jumps 36% year over year.
Right. That's massive.
Yeah. And your users are actively pouring billions of dollars in fresh cash into your platform, like completely ignoring a broader market downturn.
Throwing money at it.
Exactly. You're adding thousands of new funded accounts every single week. But then, despite all of this explosive growth, you deliberately choose to slash your operating profit margins all the way down to a seemingly meager 9%.
Which is, it's confusing to a lot of people.
It's a glaring contradiction. On paper, you're taking in more money than ever, but you're keeping way less of it. So today we are doing a special Talk Tickers deep dive into the Q1 2026 earnings call for Webull Corporation.
Ticker symbol BULL.
Ticker symbol BULL, yes. We want to find out exactly why management is making that choice. And more importantly, whether that choice makes the stock a screaming buy or, a dangerous value trap. Welcome to the deep dive. Our mission today is laser focused on you, the retail investor. We are going to extract the actionable signal from all the corporate noise. And
the dynamic you just outlined is exactly why this specific earnings transcript is so fascinating. We're looking directly at the official Q1 2026 call from May 21st.
Right.
So we've got Webull's Group President and U.S. CEO Anthony Denier alongside their group CFO H.C. Wang.
Heavy hitters.
Yeah. And what you have here is a company that has been public for, just over a year. And they are navigating this incredibly complex macroeconomic environment.
Definitely.
They're making these structural long-term bets that temporarily obscure their fundamental unit economics.
Yeah.
I mean, if you just skim the headline numbers, you're going to get the completely wrong impression of the company's health.
Well, so let's not skim, right? Let's dig into the financial physics of what is actually happening over at Webull, because the headline revenue number is a genuine jaw dropper.
It really is.
They hit $159.9 million in revenue for the first quarter of 2026.
Right.
That's a 36% jump year over year. For a platform operating at this kind of global scale, that's not a trivial achievement. It means the core engine is firing.
Yeah, absolutely firing.
But, revenue is only vanity if the profit isn't there to back it up. Okay, let's unpack this. When we look at the bottom line, Webull reported an adjusted operating profit of $14.8 million.
Mm-hmm.
If you map that against the revenue, you get that 9.3% operating profit margin. Adjusted net income came in at $9.2 million, which is like about 5.8% of total revenue.
Yeah. And to a growth investor who's, accustomed to software as a service margins.
Oh, the 70 or 80% margins.
Exactly. Seeing single-digit profit margins from a heavily tech-forward financial platform, that might immediately trigger red flags. It looks really thin.
It does.
It looks like they were barely scraping by.
I am absolutely looking at those single digits with a healthy dose of skepticism. Are these profit margins actually a win, or is there a catch? If they're bringing in almost $160 million in 3 months, why are they only walking away with $9 million in net income?
Right.
Like, are their server costs out of control? Are they bleeding money on customer support? We really need to figure out if this business is actually viable long term.
Well, the viability is proven by the consistency. And that's the most critical piece of context CFO H.C. Wang provided.
Okay.
This first quarter of 2026 actually marks Webull's 6th consecutive quarter of operating profitability.
Oh, wow. 6 quarters.
Yeah, they have not posted an adjusted operating loss since they became a public company.
So 6 quarters of unbroken profitability in the current financial climate, that's notable. We aren't living in the zero interest rate era anymore,
Right, where venture capitalists would just write blank checks.
Exactly, blank checks to cover massive operating losses just to acquire users.
Yeah, the era of, growth at all costs is completely dead. The market demands companies show a path to sustained profitability.
Definitely.
So the fact that Webull is structurally profitable while simultaneously growing their top-line revenue at 36%, that's a massive differentiator from the legacy of hypergrowth fintechs.
Yeah, a lot of their earlier competitors just burned billions to build a user base.
Hoping to eventually figure out a monetization strategy like a decade down the line. But Webull is proving that their core unit economics actually work in real time.
But see, I'm not ready to let management off the hook for that 9.3% margin just yet. We are going to dig into the expenses shortly to find out exactly where the rest of that revenue is going.
Oh, we will.
Because there is a massive line item on their balance sheet driving that compression. But first, we need to understand what that $159.9 million actually bought them in terms of market penetration.
Right.
What does the scale of Webull look like right now?
The scale is best understood by looking at the assets on the platform. At the close of Q1, total customer assets reached $24 billion.
$24 billion?
Yeah. That is a staggering 90% increase year over year. They essentially doubled the total value of assets held in their custody in just 12 months.
$24 billion is a massive amount of capital for a platform that, honestly, many traditionalists still view as the challenger brand.
Oh, for sure.
But let's look closely at the quarter-over-quarter data, because I notice a slight discrepancy here. If they are growing so fast, why did the CFO note that customer assets actually decreased slightly on a sequential basis from Q4 of 2025? Like, did they suffer capital flight? Are users suddenly withdrawing their funds?
Yeah, that's the logical first assumption, right?
Right.
But the data tells a completely different story.
Okay, lay it on me.
The sequential dip in total assets had absolutely nothing to do with users taking their money and leaving. It was entirely driven by market depreciation.
The broader market.
Exactly. The broader macroeconomic backdrop in Q1 2026 was incredibly choppy. The transcript specifically calls out the software sector sell-off, escalating geopolitical tensions, spikes in global energy prices.
Right, and persistent inflation concerns. The wider market was taking an absolute beating.
Exactly.
Or if a user holds a portfolio of tech stocks and the NASDAQ drops 10% in a month, the total value of assets on Webull's platform shrinks by 10%, even if that user didn't touch a single button.
Precisely the mechanism at play here. The total pie shrank because the underlying assets lost value, not because of capital flight.
Okay, that makes sense.
And we know this for a fact because the CFO revealed their net deposit numbers. In Q1 alone, despite that terrifying, volatile macro environment, Webull saw $2.1 billion in net deposits.
$2.1 billion in fresh capital. That is a remarkable behavioral indicator.
Yeah.
Usually when inflation fears flare up and tech stocks crater, retail investors panic. They liquidate their portfolios and move their cash into high-yield savings accounts. Or they just sit on it.
Yeah, they hide under the mattress.
Right. But you are saying Webull users actively looked at a falling market and decided to wire $2.1 billion in fresh capital into the platform.
It demonstrates an incredibly high degree of user trust and engagement. I mean, these aren't passive investors who check their 401k once a year.
No, definitely not.
These are opportunistic traders. When the market dips, they see discounted equities. They deploy capital rather than retreat. And that leads directly into the growth of their funded accounts.
Okay, let's hear the account numbers.
They're now sitting at 5.11 million funded accounts, which is up 8% year over year. They added 80,000 new funded accounts just in this quarter.
Okay, but let's stop and define our terms here, because digital brokerages are notorious for manipulating user metrics to inflate their perceived size.
Oh, absolutely.
What actually constitutes a funded account in Webull's reporting? Is it just someone who downloaded the app and threw in $5 to get a promotional fractional share of Apple?
No, actually. Webull's definition is one of the strictest in the industry. To be classified as a funded account, a customer must make an initial deposit, and the balance of that account must remain above zero for 45 consecutive calendar days leading up to the record date.
A 45-day lock-in period. Wow, that completely eliminates the promotional tourists.
Exactly.
So if I deposit $10 today, buy a stock, and then withdraw it 2 weeks later, I am never counted in that 5.11 million figure.
You are totally excluded. That 45-day window is deliberate. It ensures the user experiences a full market cycle on the platform. They see monthly options expirations. They go through an earnings cycle. They interact with the charting tools.
Right.
If the money stays for 45 days, the probability of that user becoming a long-term revenue-generating client skyrockets.
So those 5 million users are highly sticky. But, there's a much larger number sitting at the top of their funnel. They reported 27.6 million registered users.
Yeah, that's a huge gap.
It is. That means there are over 22 million people who have gone through the trouble of downloading the app, creating a login, handing over their email address, but who have not funded an account. Why is there such a massive gap? Are their conversion rates just terrible?
It looks like a massive failure to convert until you understand Webull's origin story, which CEO Anthony Denier highlighted on the call.
Okay.
Webull did not begin its life as a brokerage firm. They launched initially as a global market data platform.
Interesting.
Yeah, before they ever possessed the regulatory licenses to execute trades, they were the destination for real-time charting, financial news aggregation, and ticker tracking.
So people were using Webull the way they use Yahoo Finance or TradingView. It was basically just an information terminal in their pocket.
Yes. And because data provision doesn't require complex brokerage licenses in every jurisdiction, they accumulated millions of registered users globally.
Oh, I see.
There are users in countries where Webull legally cannot process a stock trade today, but those users rely on the app daily for the highest quality market data available in their region.
That completely reframes those 22 million non-funded users. It's not a failure to convert. It's a massive, globally distributed, zero-cost customer acquisition pipeline.
Exactly.
As Webull secures regulatory approval to launch brokerage services country by country, they don't have to spend millions on advertising to introduce themselves to the market. The app is already installed on the target demographics' phones.
It is a profound structural advantage for international expansion. But let's turn our attention back to the 5.1 million users who are actually trading.
Right.
Because the volume they are generating is the absolute engine of this company.
Right. So Wall Street relies heavily on the term equity notional volume, which is just a fancy way of describing the total dollar value of the stocks changing hands. If I buy one share of a $100 stock, the notional volume is $100. Webull reported an equity notional volume for Q1 of a staggering $261 billion.
$261 billion in a single quarter.
Insane.
That represents a 104% increase year over year. They more than doubled the dollar value of equities traded on their platform compared to Q1 of the previous year.
Wow.
And the options market saw a similar velocity. They processed 159 million options contracts for the quarter, up 31% year over year.
We also have to look at the sequential growth here. Equity volume was up 9.2% from Q4, and options were up 3.2% from Q4. Why is the sequential growth so important?
Because it reveals a massive divergence from the legacy brokerage industry. During the Q&A portion of the earnings call, an analyst from Bank of America brought up a really stark reality.
What was it?
Many of Webull's legacy competitors, the established institutions that have been around for decades, actually reported broad sequential declines in equity and options volume from Q4 to Q1.
So the wider industry experienced a slump, yet Webull accelerated.
What's fascinating here is that exact divergence.
I want to dig deeply into the mechanics of why that divergence exists. If the macro environment is universally choppy and everyone is facing the same inflation fears and geopolitical headlines, why are the customers at traditional brokerages trading less, while Webull's customers are trading significantly more?
So Anthony Denier broke this down into three core drivers. The first is pure demographics and user psychology.
Okay.
Webull's platform is custom built for the active retail trader.
Oh, yeah.
When you have a market defined by escalating volatility, when the VIX spikes and the intraday swings widen, the casual investor at a legacy firm experiences anxiety.
Right.
Their natural reflex is to sit on their hands, stop trading, and wait for the storm to pass.
Yeah, the classic buy and hold investor doesn't want to look at their portfolio when the market is dropping 2% a day.
But the active trader thrives on that exact volatility. Volatility creates pricing inefficiencies and massive intraday opportunities.
Makes sense.
If a stock trades flat all day, there is no margin to capture. If it swings wildly, the active trader leans in. Webull's user base sees macro turbulence as a catalyst for action, not a reason to retreat.
So their very specific customer persona acts as a natural hedge against market slumps. That's incredibly smart. What were the other two drivers?
The second is the sheer velocity of their international growth. Their broker-dealers operating outside the United States are seeing explosive increases in volume. They're capturing massive market share in fresh territories.
Oh, nice.
And the third factor is a tidal wave of institutional money quietly flowing into the platform, which fundamentally alters the company's DNA.
Okay, we are going to dedicate a lot of time to that institutional money in just a moment, because it completely redefines how we should value this company. But first, we have to confront the reality of the balance sheet.
Here we go.
We have established that top-line revenue is surging, assets are growing, and trading volumes have doubled. But we still have that anemic 9.3% operating profit margin. Where's all the cash going?
This is the friction point of the entire earnings report. In Q1, Webull's adjusted operating expenses skyrocketed to $145.1 million. That is a 64% increase in costs year over year.
This is where I start sounding the alarm bells. If your revenue is growing at 36%, but your expenses are compounding at 64%, the mathematical outcome is eventual disaster.
It looked bad on paper.
You cannot sustain a business where the cost of operating outpaces the cash coming in by nearly a 2-to-1 ratio. Are they bloating their headcount? Are they overpaying for engineering talent?
The CFO, H.C. Wang, he anticipated this exact reaction, and he offered total transparency regarding the expense structure. This 64% spike is not driven by bloated infrastructure, skyrocketing server costs, or an out-of-control payroll.
Okay, and what is it?
The vast majority of that expense increase is a deliberate, proactive allocation of capital into marketing and brand building. They are buying customer acquisition.
Buying customer acquisition. Let's translate that. They are aggressively spending money to convince people to open those funded accounts. What specific mechanisms are they using? Are they just buying digital banner ads?
It is far more aggressive and structural than digital ads. They outline several major initiatives. First, they are running aggressive global asset matching programs.
What does that mean?
This means they are offering direct financial incentives, often cash or stock equivalents, to incentivize high net worth retail users to transfer their entire portfolios over from competing brokerages.
So they are effectively paying a bounty to poach highly lucrative accounts from the legacy firms.
Yes. Secondly, they are funding massive, localized awareness campaigns across international markets like Hong Kong, Canada, and Australia. Heavy promotion of their zero-commission trading structures.
Right.
But the most visible, high-profile expenditure is happening right here in the United States. They recently signed a deal to become the first official jersey patch sponsor for the Tampa Bay Rays Major League Baseball team.
The Tampa Bay Rays. So for the entire 162-game season, every time a player steps up to the plate, the Webull logo is physically stitched onto their uniform.
Exactly.
That is premium blue-chip sports marketing real estate, and it requires a monumental financial commitment.
It is a marquee sponsorship. Management justified the expense by noting their corporate headquarters are actually located in St. Petersburg, Florida.
Oh, I didn't know that.
Yeah. So they view it as a strategic move to cement immense brand visibility in a priority regional market, while simultaneously capturing national broadcast exposure.
See, I am going to push back incredibly hard on this entire strategy. I don't buy that paying tens of millions of dollars to put a patch on a baseball jersey is a sound allocation of capital for a digital brokerage.
Really?
Yeah. This feels uncomfortably similar to the zero interest rate era of 2021, where companies would just set huge piles of cash on fire to inflate their user numbers ahead of a funding round.
That is the standard critique of heavy consumer marketing spend. You fear they're inflating a bubble.
Look at the streaming wars. We watched platforms like Netflix, Disney Plus, and Max burn through billions of dollars producing massive original shows. They were essentially subsidizing the cost of content just to bribe users into signing up.
Sure.
But the fatal flaw of the streaming war was the churn rate. A user would sign up, binge the specific show they wanted in one weekend, and then cancel their subscription on Monday morning. The platform spent massive customer acquisition dollars to rent a user for 3 days. My question for Webull is, are these aggressive asset matching programs and baseball sponsorships actually creating loyal, lifelong traders, or are they just renting these accounts for 45 days until the promotional bonus clears?
Well, if they were experiencing streaming level churn, their unit economics would collapse within a year. But the data firmly rejects the renting thesis.
Show me the data.
CFO H.C. Wang provided a metric that essentially serves as the ultimate defense of this marketing spend. In Q1, Webull's quarterly retention rate hit a record high of 98.4%.
Let me process that. A 98.4% retention rate implies that less than 2% of their funded accounts are leaving the platform in any given 3-month period.
Precisely. The mechanical friction of changing brokerages is fundamentally different from canceling a streaming service.
Yeah, that's fair.
Moving financial assets requires filling out AC sheet forms, dealing with settlement periods, and potentially navigating complex tax implications.
It's a huge headache.
Once Webull utilizes its marketing budget to incentivize a user to cross that friction threshold, fund the account, and keep the money there for that crucial 45-day window, the platform's user experience and data tools take over. The platform is inherently sticky.
So the lifetime value, or LTV, of a Webull customer is astronomical compared to the customer acquisition cost, even when that acquisition cost includes a massive baseball team sponsorship.
Exactly. And this brings us back to the most important revelation of the entire earnings call. The context that fundamentally changes how we view that anemic 9.3% operating margin.
What's the context?
Wang stated explicitly that if you were to isolate the business, if you completely turned off all of the proactive, discretionary marketing spend, Webull's underlying operating profit margin has remained at or above a remarkably healthy 40% every single quarter since Q3 of 2024.
Hold on. You are saying the actual machinery of the business, the trade execution, the margin lending, the software infrastructure runs at a 40% profit margin.
The core unit economics are wildly lucrative. The 9.3% margin we see on the headline is just an optical illusion created by a strategic choice.
Oh, wow.
Management is not failing to operate a profitable business. They are deliberately choosing to suppress their immediate profitability. They are taking those massive 40% margins and consciously reinvesting the surplus directly into acquiring permanent global market share.
So management's philosophy is essentially, we refuse to optimize for short-term quarterly profits when there is a massive land grab available globally. They are sacrificing the present to dominate the future.
Exactly. It is a calculated, aggressive stance. But while the loud, expensive consumer marketing, the sports sponsorships, and zero-commission ads dominates the expense sheet, there's a quiet, incredibly sophisticated revolution happening deep within the plumbing of the company. Webull is undergoing a metamorphosis.
And this metamorphosis forces us to completely reevaluate the company's identity. If you stop a random retail investor on the street and ask them what Webull is, they will probably describe a flashy smartphone app used by day traders to flip options or meme stocks.
Sure.
But the data from this call proves that Webull is no longer just a consumer-facing retail application. Here's where it gets really interesting.
They are quietly building a massive B2B institutional Trojan horse. This was perhaps the most staggering statistic shared on the call. Nearly 10%, specifically 9.5% of all of Webull's equity notional volume in Q1 was generated by institutional flow.
Let's truly internalize the scale of that. 1 out of every $10 moving through Webull's equity matching engines is no longer coming from a retail trader on their couch. It is coming from a sophisticated professional institution.
Right.
How does a retail app transition into an institutional powerhouse so rapidly?
By recognizing that their technological infrastructure is their most valuable asset. They have spent years building a highly regulated, remarkably efficient execution engine for U.S. equities. They realized they could essentially white label that infrastructure.
Oh, I see.
Management highlighted a major partnership in South Korea with a prominent financial firm called Meritz. But Meritz is just one piece of the puzzle. CEO Anthony Denier revealed they have successfully onboarded nearly 200 institutional clients to their B2B platform.
We need to explain the mechanics of a B2B brokerage relationship. Why would a massive South Korean financial institution need to route their trades through Webull? Don't they have their own technology?
It comes down to regulatory complexity and execution costs. If an institution in South Korea or Europe wants to offer its local retail clients the ability to actively trade U.S. stocks, they face an enormous barrier to entry. They have to navigate SEC regulations, build cross-border settlement infrastructure, manage currency translation, and secure direct market access to U.S. exchanges. Building all of that from scratch requires years of development and tens of millions of dollars in compliance costs.
So instead of building the highway themselves, they just pay a toll to use Webull's highway.
Exactly. The South Korean institution maintains the direct relationship with their local client. They handle the local language customer support and the domestic regulatory compliance.
Right.
But when that client clicks buy on a share of Tesla, the institution routes the order via an API directly into Webull's back-end systems. Webull processes the execution flawlessly in the U.S. markets and takes a small slice of the transaction revenue for providing the plumbing.
That is an incredibly elegant business model. Webull gets massive volume and revenue without having to spend a single dollar on consumer marketing in that specific foreign market. The local institution acts as the acquisition funnel.
And the volume this B2B strategy generates is difficult to comprehend. Webull currently operates 14 different broker-dealers across the globe. Denier revealed that the equity flow coming exclusively from their Hong Kong broker-dealer is now a close second to the volume generated by all 13 of their other global broker-dealers combined.
Wait, one single regional office in Hong Kong is nearly out-trading the rest of their entire global footprint. How is that mathematically possible unless the entire population of Hong Kong is day trading constantly?
It is not retail volume. That Hong Kong office is functioning as the central nervous system for their entire Asia-Pacific B2B and institutional operation. It serves as the gateway where massive pools of capital from Asian institutions plug into Webull's API plumbing to access U.S. markets. Denier made it explicitly clear that this 9.5% institutional volume is just the beginning phase. They expect B2B flow to accelerate aggressively over the next several quarters.
From an investment thesis perspective, this completely de-risks the company. A common bear argument against retail brokerages is that their revenue is cyclical.
Yep.
If the market goes flat for 2 years and retail traders get bored and stop trading, the brokerage's revenue collapses. But if Webull establishes a massive baseline of automated, high-volume institutional flow, they create an incredibly stable, unshakable floor for their earnings. It insulates them against retail fatigue.
It is a phenomenal structural pivot. We've established their dominance in core equities and options and their expansion into institutional flow. But to understand the full revenue picture, we also have to look at product diversification. What else are these millions of users trading?
The secondary product lines are showing staggering momentum. Futures trading on the Webull platform grew by 84% year over year. Let's dig into why futures are suddenly so popular, because it ties directly back to that choppy macroeconomic environment we discussed earlier.
When geopolitical tensions rise or supply chains are disrupted, traditional equity markets often suffer. But those exact same crises create massive volatility in commodities. Denier specifically highlighted surging retail interest in oil and broader commodities futures.
Right. If you are an active trader watching the news and you see conflict in an oil-producing region, you know the price of crude is going to move violently.
Obviously.
If you only have access to stocks, your ability to capitalize on that specific thesis is limited to buying shares of an oil company, which carries its own corporate risks. But with futures, you can trade the underlying commodity directly.
By offering seamless access to futures directly within the primary Webull app, they prevent capital leakage. If an active Webull trader wanted to speculate on oil prices and Webull lacked a futures product, that user would be forced to withdraw their capital and open a secondary account with a specialized futures brokerage.
Which they don't want.
Right. By having a comprehensive product suite, Webull captures the trade and keeps the capital locked inside their ecosystem.
That brings us to the most debated asset class in retail finance, cryptocurrency. You cannot discuss the modern retail trader without discussing their appetite for crypto. Is Webull actually moving the needle in the digital asset space?
The crypto data presented on the call is absolutely fascinating, and it represents a massive, untapped reservoir of potential revenue. Currently, cryptocurrency trading is a surprisingly small fraction of their overall business. It accounts for only about 2% of Webull's total revenue.
2%? That seems remarkably low. When you look at some of their direct competitors in the retail fintech space, crypto often represents 15% or even 20% of their total revenue pie. Why is Webull lagging so far behind in monetizing crypto?
And I was very candid about this. They intentionally delayed the rollout of several major crypto product features. Specifically, they pushed back the launch of crypto staking and the highly anticipated feature allowing users to transfer coins directly in and out of external wallets.
Really? What?
They chose to reallocate their engineering resources toward building out their artificial intelligence tools, which we will discuss shortly.
So they deliberately sacrificed short-term crypto revenue to build long-term AI infrastructure. But does the demand for crypto still exist within their user base? Or did those users abandon them for a dedicated crypto exchange?
The demand is overwhelming. Denier shared a statistic that proves the crypto opportunity is essentially a coiled spring waiting to be released. Of all the new funded accounts opened year to date, 20% of those users made their very first trade on the platform in cryptocurrency.
Let me make sure I understand the gravity of that. 1 out of every 5 new users who went through the friction of funding an account bypassed Apple, bypassed Tesla, bypassed the S&P 500, and immediately sought out a digital asset for their very first transaction.
Exactly. The top-of-funnel intent is massive. The users are arriving with capital specifically earmarked for crypto. Denier argued that because they have already captured this massive audience, there is a very clear, straightforward path to taking that 2% revenue contribution and rapidly scaling it up to 15% or 20%.
Just by launching those features.
All they have to do is finally release those delayed features, staking, and external wallets in Q2. The audience is already sitting there, waiting to utilize them.
So it's not a matter of having to spend millions on marketing to convince their users to trade crypto. They simply have to turn on the functionality to monetize the behavior that is already occurring. That is a highly efficient growth catalyst.
It is. So we have now thoroughly mapped out the present state of the company. We understand how they bought their growth, why their margins are temporarily compressed, the brilliance of their institutional B2B API strategy, and the latent potential in their crypto product.
Right.
But the true value of an earnings call is what it tells us about the future.
Which means we need to pivot to the catalysts. What specific structural changes are occurring over the next 6 months that will radically accelerate Webull's business? Why should a listener holding this stock feel confident going into Q3 and Q4?
No.
The biggest, most immediate catalyst discussed on the call revolves around a regulatory shift. We need to talk about the PDT rule.
The PDT, or Pattern Day Trader Rule, is an SEC regulation that has been the absolute bane of existence for active retail traders for years. It is a fundamental bottleneck on trading velocity.
Let's explain the mechanics of this rule for those who might primarily invest in long-term index funds and have never run afoul of it. How did the PDT rule function prior to June 4th of 2026?
The rule dictated that if your brokerage account held less than $25,000 in total equity, you were strictly limited in your intraday trading capacity. Specifically, you were legally prohibited from executing more than 3-day trades within any rolling 5 business day period.
To clarify, a day trade is defined as opening and closing a position on the same security within the same trading day. If I buy 100 shares of NVIDIA at 9:30 a.m. because I see momentum, and I sell those shares at 10:15 a.m. to lock in a profit, I have consumed one of my 3 allotted day trades.
Correct. Under the old regime, if your account sat at $15,000 and you successfully executed 3 of those quick intraday trades by Wednesday, you were effectively paralyzed for the rest of the week.
Wow.
If the perfect textbook setup materialized on Thursday morning, you were locked out. If you attempted to execute a 4th trade, the brokerage was legally required to freeze your account for 90 days.
The rule was originally implemented after the dot-com bubble burst as a paternalistic measure by regulators. The theory was that it would protect undercapitalized, inexperienced retail investors from gambling away their rent money on the intraday volatility of the market.
That was the idea, yeah.
But in practice, for a sophisticated active trader utilizing tight stop losses, it was a suffocating restriction that actually increased risk by forcing them to hold positions overnight just to avoid burning a day trade.
Well, during the earnings call, management announced a seismic shift in the regulatory landscape. As of June 4th, the PDT restriction is effectively being eliminated for qualified accounts.
And we must explore why this specific regulatory change is uniquely and disproportionately bullish for Webull compared to the rest of the industry. Let's look at the legacy brokers, the Charles Schwabs or the Fidelities. Why don't they care about the PDT rule elimination?
Because it doesn't impact their core demographic. The average client at a legacy institution might be a 55-year-old with a $400,000 IRA who rebalances their portfolio once a quarter. They easily clear the $25,000 equity threshold, so the PDT rule never applied to them in the first place.
But Webull's demographic is entirely different. Anthony Denier revealed a crucial data point. The average account size across Webull's millions of users is just under $5,000.
Which means the vast majority of their 5.11 million funded accounts have been operating under the suffocating constraint of this 3-trade limit. Overnight, on June 4th, that leash was completely removed from millions of active traders.
The impact on transaction volume must be staggering. If you suddenly allow millions of users who want to trade daily the freedom to actually do so, the revenue implications for Webull's order flow are massive. Did management attempt to quantify this impact?
Denier laid out a remarkably conservative modeling scenario. He built a bear, neutral, and bull case for the post-PDT environment. Even in his absolute worst-case scenario, his baseline bear case, he projects a minimum 20% immediate increase in total transaction volume across the platform simply by removing the restriction.
An instant 20% boost to your core product usage without having to acquire a single new user or launch a new feature.
Right.
But the strategic opportunity extends far beyond just organic volume increases. It presents a massive opportunity for asset consolidation.
This requires an understanding of the behavioral psychology of the restricted active trader. Denier outlined a fascinating, almost absurd reality of how traders navigated the PDT era.
Okay.
Imagine a trader with a total liquid net worth of $12,000.
Yeah.
Because that is below the $25,000 threshold, they are restricted. To legally hack the system and get more day trades, they wouldn't keep all $12,000 in one account.
Right. They would fragment their capital. They would open an account on Webull and deposit $4,000. They would open a second account on Robinhood and deposit $4,000, and maybe a third account on a legacy app with the remaining $4,000.
Yep.
By splitting their money across 3 distinct platforms, they could execute 3 day trades on app A, 3 on app B, and 3 on app C. They purposefully fractured their own capital just to secure 9 total day trades a week.
It was an incredibly inefficient, frustrating user experience. They had to manage multiple logins, navigate disparate interfaces, and deal with complex, fragmented tax reporting at the end of the year. With the PDT rule eliminated, that entire strategy becomes obsolete.
Completely obsolete.
There is absolutely no logical reason for a user to maintain 3 different subscale brokerage accounts. The natural, rational move is to consolidate all of that fragmented capital into whichever single platform offers the best execution and tools.
And Webull is aggressively positioning itself to be that single destination. Denier stated they have orchestrated massive Q2 and Q3 marketing campaigns specifically designed to incentivize this exact consolidation behavior.
Right.
They are rolling out the red carpet to convince users to close their Robinhood or legacy accounts and move the entirety of their capital onto Webull. They are treating June 4th as the starting gun for a massive market share land grab.
It is a profound structural tailwind that perfectly aligns with their core demographics needs. But while the PDT rule elimination serves as a powerful catalyst for today's trading environment, management spent a significant portion of the call detailing a catalyst designed for the trading environment of tomorrow.
Okay, what is it?
We must delve into Webull's vision for an agentic AI future.
This was the segment of the call that truly felt like a glimpse into a science fiction novel, yet Denier discussed it with absolute seriousness. He made an incredibly bold, paradigm-shifting claim about the nature of retail finance.
He really did.
He argued that for the last 10 years, digital brokerages competed fiercely on user interface who had the most intuitive app, the sleekest dark mode, the most frictionless buttons to execute a trade. But he declared that the era of competing on human interface is rapidly drawing to a close.
It's over.
According to management, the future of retail trading is no longer a human physically tapping a screen on a smartphone. The interface of the future is an API interacting seamlessly with an AI agent.
He is predicting a fundamental evolution in how capital is deployed by the retail sector. The vision is a decentralized ecosystem where users empower sophisticated third-party AI bots, these autonomous agents, to execute complex trading strategies on their behalf entirely automatically, 24 hours a day.
Wow.
Webull's grand strategy is not to build the bots themselves, but to construct the foundational, underlying plumbing, the execution layer for this entirely new paradigm.
We need to make this concrete because it sounds highly theoretical. How are they actually building this infrastructure? What is the technology they are deploying today?
They are actively rolling out the necessary architecture. The prime example announced on the call is the release of their MCP server. For those outside of software engineering, an MCP, or Model Context Protocol server, functions as an ultra-secure, highly robust bridge.
Okay.
It allows external, third-party AI agents developed by entirely separate companies to interface natively with Webull's core trading platform.
Let me use an analogy to clarify this. Think of the modern financial market as a massive, high-speed, autonomous vehicle highway. The AI agents, the trading bots, are the self-driving cars.
Good analogy.
They possess the intelligence to navigate, to speed up, to slow down based on conditions. But a self-driving car is useless without a perfectly paved road, standardized traffic signals, and robust safety guardrails. Webull's is building the highway.
Exactly.
They are providing the low latency API connections, the regulatory compliance checks, and the secure execution engine so that developers can unleash their AI cars onto the market.
That is an excellent framework. They want to be the undisputed infrastructure layer for agentic trading. But they aren't completely abandoning the human trader in the interim.
Right.
While they construct the third-party highway, they are simultaneously deploying powerful internal AI tools designed to augment human decision-making today. The standout product currently in beta testing is called Vega Analysts.
The concept behind Vega Analysts addresses a massive historical inequity in the financial markets. Historically, if a retail investor wanted to research a stock, their tools were incredibly limited. They might read a few free, superficial articles on Yahoo Finance, scan a Reddit thread for sentiment, or look at a basic moving average chart.
Very shallow research.
Exactly. But a professional institutional investor at a major hedge fund has access to deeply nuanced 50-page customized reports generated by armies of sell-side analysts at investment banks.
Vega Analysts is explicitly engineered to democratize that institutional-grade analysis. Using advanced language models, a retail investor on the Webull app can request a comprehensive, customized research report on any publicly traded company.
Wow.
Within minutes, the AI synthesizes earnings transcripts, macroeconomic data, technical indicators, and sentiment analysis to generate a deeply insightful report that rivals traditional sell-side research in depth and quality.
It bridges the information gap between Wall Street and Main Street, and the early engagement metrics are astonishing. Denier noted that active traders participating in the Vega Beta program are requesting these reports 16 to 17 times per month.
That's a lot.
But the most critical metric is the conversion rate. 20% of the time, immediately after reading the AI-generated report, the user executes a trade.
The tool is directly driving monetization. It isn't just a gimmick, it is an engine for order flow. Furthermore, they are launching Portfolio Blueprint, a tool enabling one-click algorithmic portfolio construction and seamless copy trading.
Interesting.
And slated for later this year is AI Portfolio, which will introduce basic agentic automated decision-making directly into the native Webull application. They are systematically surrounding the user with AI execution capabilities.
But we have to address the inherent risks of this vision. If you grant a machine autonomous control over your life savings, the potential for catastrophic failure is terrifying.
Oh, without a doubt.
During the Q&A, an analyst from Wolf Research raised a highly critical point regarding rogue behavior. If Webull allows third-party AI bots to connect via an API and execute trades, what happens when an AI hallucinates?
Yeah, the flash crash scenario.
What happens if a minor coding glitch in an external bot causes it to frantically execute 1,000 trades a second, completely bankrupting the retail user before a human even notices?
It is the ultimate nightmare scenario. A localized, personalized flash crash that destroys an individual's net worth. The regulatory and reputational risks for Webull in that scenario are immense.
How did Denier respond to that existential threat?
He was unequivocal in prioritizing risk management. He emphasized that Webull's paramount focus during this AI rollout is security, strict compliance, and rigorous customer protection. They are not simply opening the floodgates.
Okay, good.
They are collaborating extensively with regulatory bodies to architect robust, fail-safe risk control frameworks specifically tailored for agentic trading. This involves implementing hard exposure limits, mandatory user notifications, and kill switches.
Essential stuff.
But his ultimate conclusion was defiant. Despite the profound risks and the regulatory complexity, agentic trading is the undeniable future of finance. The brokerage firm that successfully engineers the most reliable, secure, and developer-friendly execution infrastructure will dominate the next decade of the industry.
So we have the immediate volume catalyst of the PDT rule elimination and the long-term volume catalyst of the AI infrastructure build-out. But there is a third major catalyst discussed on the call that has absolutely nothing to do with increasing trading volume.
Right.
It is entirely focused on radically expanding their profit margins on the volume they already possess. We need to translate another dense piece of Wall Street terminology: self-clearing.
The announcement regarding self-clearing is arguably the most financially consequential, structurally transformative piece of information in the entire earnings transcript. To grasp why it matters, we must dissect the invisible plumbing of a standard stock trade.
Let's walk through the mechanics. When a user opens the Webull app, navigates to Apple, and clicks Buy, the interface flashes green and the shares appear in their portfolio instantly. But behind the scenes, Webull doesn't actually process the final settlement of that transaction.
No, they don't.
They don't hold the physical stock, and they don't finalize the exchange of cash for the asset. Historically, they have relied on a massive third-party middleman, a clearinghouse like Apex Clearing, to officially record the transaction, manage the regulatory settlement, and custody the asset.
Precisely. And that middleman does not work for free. Every single time a Webull user executes a trade, Webull must pay a small transactional toll to the clearing firm.
Okay.
When your user base is executing millions of trades every single day, those microscopic tolls aggregate into a massive, structurally debilitating operational expense. It eats directly into their profit margins.
Well, the massive news from the Q1 call is that Webull has finally navigated the incredibly rigorous regulatory labyrinth to receive official approval for their own U.S. self-clearing license. They are officially cutting out the middleman.
It is a monumental achievement, though denier caution that the implementation is a complex, phased process.
Yeah.
Securing the license is merely the first step. They must now undergo extensive technological integration and secure final operational approval from the DTCC, which manages the settlement of equities, and the OCC, which handles a significantly more complex settlement of options contracts. Management anticipates that the entirely self-cleared system will be fully operational by the end of the year, likely in the fourth quarter.
Let's explore the financial physics of what happens in Q4 when that integration is complete and they finally flip the switch to self-clearing.
The transformation is immediate and profound. By internalizing the clearing process, their per-transaction costs plummet dramatically.
Wow.
Every single equity and options trade executed on the platform instantly becomes significantly more profitable. As CFO H.C. Wang articulated, it generates meaningful synergies and massive operating leverage. It is a permanent structural expansion of their profit margins.
It fundamentally changes the math of the business. Instead of passing a fraction of a cent to Apex on every trade, that fraction of a cent flows directly to Webull's bottom line. But it's not just about cost savings. It also creates a massive competitive advantage for that B2B institutional business we discussed earlier.
Exactly. Because Webull's internal costs will drop so significantly, they possess the flexibility to pass a portion of those cost savings onto their institutional B2B clients in South Korea, Hong Kong, and Europe.
That's huge.
They can offer more aggressive pricing to institutions, making their API infrastructure the undisputed most cost-effective routing option globally, thereby capturing even more market share. It is a compounding flywheel of efficiency.
To round out our analysis of management's guidance, we should briefly touch upon their ongoing global expansion efforts and a major structural win for retail investor transparency.
On the international front, the momentum is accelerating. During Q1, they secured regulatory permission to commence operations in 22 additional markets within the European Economic Area.
And they recently officially launched their platform in Germany.
Yes, they now operate seamlessly across 15 total global markets and offer highly disruptive zero-commission trading models in 7 countries outside the United States.
They're systematically exporting the highly polished, zero-friction U.S. retail trading experience to international markets that have historically suffered under high fees and clunky legacy interfaces. But what about the transparency win? This is a development that I believe every retail investor should celebrate.
It is a significant departure from standard corporate behavior. CFO H.C. Wang announced that moving forward, Webull will voluntarily begin publishing their key operating metrics on a monthly basis, rather than adhering strictly to the mandated quarterly schedule.
This is a phenomenal development for shareholders. Typically, when you invest in a company, you are forced to fly blind for 90 days.
Yeah, just waiting.
You have to wait anxiously for the quarterly earnings call to discover if the business is thriving or collapsing. By committing to publishing monthly metrics, including active user counts, trading volumes, and margin loan balances, Webull is granting retail investors near real-time visibility into the operational health of the company.
It demonstrates supreme confidence in their trajectory, and Wang couldn't resist offering a brief, highly optimistic preview of those upcoming reports.
What did he say?
He casually noted that the preliminary monthly metrics for April and May are already indicating that trading volumes and market share are hitting all-time historic highs, actively accelerating past the already explosive Q1 numbers we've spent the past hour dissecting.
That tease of the April and May data serves as the perfect segue to conclude our analysis. We have exhaustively mapped out the terrain. We have scrutinized the top-line growth, the temporary margin compression driven by marketing, the profound pivot toward B2B institutional infrastructure, the imminent volume surge from the PDT rule elimination, the foundational AI architecture, and the massive margin expansion arriving with self-clearing.
We covered it all.
We have examined every facet of the business. Now it is time to synthesize this data into a definitive verdict. So what does this all mean?
This is the moment where we move from objective analysis to opinionated stance.
Based on the totality of the Webull Q1 2026 earnings call, what is our talk ticker's bottom line? Our definitive verdict is that this quarter represents a powerful, undeniable, bullish signal.
It is a highly bullish signal, but it requires a sophisticated investor who comprehends the defensive architecture of their strategy. If you are a superficial analyst who only reads the headline noting that operating expenses surged 64% while profit margins compressed to 9.3%, your instinct might be to panic and sell.
Right.
The bullish thesis relies entirely on understanding and trusting the underlying obfuscated unit economics.
You must look past the consumer marketing noise and focus on that 40% adjusted operating margin. That metric proves the core execution engine of the company is incredibly lucrative. Management is engaging in a deliberate, aggressive strategy of sacrificing short-term optical profitability to fund a massive global land grab.
Exactly.
And because they boast a 98.4% retention rate among funded accounts, we know that the market share they are purchasing today is virtually permanent. They are not setting cash on fire. They are utilizing their profits to acquire long-term annuities in the form of highly loyal, hyperactive traders.
Furthermore, the structural diversification of their revenue streams provides phenomenal downside protection. The bear case against Webull was always that they were dangerously reliant on the manic energy of the meme stock retail trader. That is no longer true.
Not at all.
With nearly 10% of their equity flow now originating from deeply entrenched B2B institutional partnerships and their international broker-dealers experiencing triple-digit growth, they have engineered a robust, weatherproof financial platform capable of thriving in any macroeconomic environment.
So let's distill this into an actionable roadmap for you, the investor. If you currently hold the stock, or if you are sitting on the sidelines considering initiating a position, the timeline of catalysts is incredibly clear and easy to track. Here is your operational checklist for the remainder of 2026.
Let's hear it.
First, monitor the immediate aftermath of the June 4th PDT rule elimination. Scrutinize the newly available monthly metrics for June and July to verify if deniers' projected 20% baseline surge in transaction volume actually materializes in the data. Look for evidence that their marketing campaigns are successfully consolidating capital from fragmented competitor accounts into the Webull ecosystem.
Second, pay close attention to the rollout of their delayed crypto features in Q2 and Q3. When they finally deploy staking and external wallet transfers, track whether they successfully convert that massive top-of-funnel interest, the 20% of new users who make crypto their inaugural trade, into sustained revenue that rapidly scales their crypto division past its current 2% contribution.
And finally, the most significant long-term milestone. Anchor your expectations to the fourth quarter of this year. When the U.S. self-clearing integration with the DTCC and OCC goes fully live, watch for the middleman clearing expenses to vanish from the balance sheet, resulting in a dramatic structural expansion of their profit margins.
All laid out.
The blueprint for value creation has been laid out perfectly in front of us. The burden now lies entirely on management's ability to execute the technical integration.
It is a company operating with an incredibly ambitious, multi-pronged strategic vision, and the Q1 data strongly suggests their execution is matching their ambition.
Thank you for joining us for this extensive Talk Tickers deep dive. We hope we've successfully stripped away the corporate jargon to provide you with a clear, actionable understanding of Webull's true operational health. But before we sign off, we always like to leave you with a final, provocative thought to mull over, something that builds upon the data we've discussed today, but pushes the boundaries of the narrative into a slightly uncomfortable territory.
This raises an important question. Analyzing Webull's overarching strategy reveals a fascinating, perhaps irreconcilable paradox at the heart of their business model.
What's the paradox?
We spent a significant portion of our analysis scrutinizing the massive capital they're deploying on consumer-facing marketing. They are spending tens of millions of dollars to stitch their corporate logo onto the jerseys of the Tampa Bay Rays. plastering their brand across stadiums and international billboards solely to capture the attention of human beings and drive app downloads.
It is an incredibly aggressive, highly expensive marketing strategy designed exclusively to appeal to human psychology.
Yet, later in the very same earnings call, CEO Anthony Denier firmly declared that the era of the human trader is ending.
Oh, wow.
He forcefully articulated a vision where, in just a few years, humans will no longer be the primary entities executing trades. He believes the ultimate interface of the future is an API, and that autonomous AI agents will be making the execution decisions and interacting with the Webull platform on behalf of the user.
The contradiction is glaring.
If Webull's ultimate strategic destiny is to transition away from being a flashy, colorful consumer application that humans tap on their smartphones, and instead become a silent, invisible, hyper-efficient back-end infrastructure layer powering third-party AI trading bots, does consumer branding even hold value anymore?
That's a great point.
An algorithmic AI agent does not care if your logo is prominently featured on a Major League Baseball jersey. A machine learning model is not persuaded by a clever Super Bowl advertisement or a zero-commission promotional banner. An AI agent cares exclusively about latency, API reliability, execution speed, and fractional transaction costs. So the question we must ask is, if the future of retail finance is truly agentic and entirely automated, will Webull's massive ongoing investments in legacy, human-centric consumer branding eventually become entirely obsolete?
It is a profound philosophical contradiction at the core of their capital allocation strategy. Are they spending millions building a beloved consumer brand for a human user base that their own technology is actively attempting to render obsolete? We invite you to explore that thought on your own, keep questioning the prevailing narratives, demand explanations for the data, and keep diving deep into the financial physics of the companies you own. We will catch you on the next deep dive.